In our income statement for a bank, we're going to have major expenditure items. Major expenditure items. And what can we expect those to be looking at a bank's income statement? A big one, potentially the biggest, is the interest expense. Why is that? A significant portion of the capital that the banks are using to advance loans to people is borrowed. And they have to service that by way of an interest expense. So your interest expense is probably going to be the biggest, if not one of the biggest expenses in the income statement of a universal bank. In addition to that, other significant expenses will relate to human resources. Employing all those people ties up a lot of money. There may be significant expenses by way of credit impairments, or what we call bad debts. When the bank loans $1 million to a third party and that party fails to pay that principal back, we call those credit impairments or bad debts. Because banks have got a significant infrastructure in terms of buildings, they will also usually have a significant depreciation expense. That depreciation expense relates to the buildings, the computer hardware and infrastructure that the bank uses, and that's very significant in most banks. Allied to that, because banks make significant investments in enabling software, the amortization expense on intangible assets is frequently going to be quite significant as well. Other related fee expenses will be incurred, especially when they are transacting with other banks or third parties. And the obvious expenses, marketing, regulatory expenses, etc., and so forth, will also come through in the income statement. So those are the major expenses you can expect to see in the income statement of the bank. The interest expense, the amortization and depreciation expenses, the impairment expenses, some of the fee expenses that are really striking when you look at a bank's income statement.